Ladies and gentlemen of the crypto space, we're live on Wednesday, August 24th at 11:36 a.m. Markets are always doing what they're doing macro. We've talked a little bit about it over the last couple of days, and it has been a wild show to say the least. But as always, I like to come back to storytelling to give us the best capacity to see these assets for what they are, to see these things that we can purchase for their potential of what they could do for us, which is something rare, I would say, in this world of equities and this world that enterprise offers us. We haven't had this type of potential for to purchase ownership of enterprise that could work for us. It used to be like that with value investing in the golden days of equities markets, but value investing doesn't work the same way. I would imagine Buffett and Munger are probably like, well, actually, that's exactly why they call so many things rat poison. And I'm sure in their older years, their twilight years, they're like, oh, it's horrible. That's why they have the presentation, the opinion, or the sentiment that they express in a lot of their meetings. They're disgusted with growth and disgusted with what things have become. I'm sure they're getting paid a lot of money from their Apple stock. And it's not just appreciation from a growth perspective. I'm sure they're getting paid, and that's what they do. That's why they do what they do. That's why we do what we do. We want productive assets that pay us. So that's why we're here. But to understand what to look for and why these markets are so meaningful, you have to understand the stories. And then you could use the stories to identify assets that can contribute to the value narrative, that could add value to your portfolio, that could pay you ultimately. The few profound phenomena of the crypto space. Now, obviously, this all starts with UTXO, and I have a lot of opinions about UTXO blockchains, and I would imagine we talk DeFi a lot. A lot of folks probably don't even know what the fuck a UTXO blockchain is. It's Bitcoin, it's Litecoin, it's Digibyte, it's all the original proof of work chains, the forks of Bitcoin that have gone in different directions and have done different things. And that obviously is a profound innovation for reasons that most don't understand, especially critics. It has, and yes, consensus is meaningful, but there are applications that most just don't realize. And in the coming weeks and months, um, that's something I may be entertaining. I may circle back around next month and I'll talk about something I may be doing at the end of September, and it could be interesting. Um, could be interesting. Digibuy related. Go figure. UTXO is not going away. Proof of work is not going away, and that's meaningful. Anytime something is not going away, it means it's going to be used. It becomes infrastructure, it becomes utility. And you'll end up seeing something in 10 years that you could do with something, some sort of utility now that's just not seen now. And that's profound. So that's the historic, profound thing I could offer you guys today. But there's two other profound things that are always on my mind. One is stablecoins. Stablecoins are probably the biggest thing in the entire crypto space. Why? Because the most popular, the most successful stablecoins are CDPs, which are euro dollars. So stablecoins truly are a public-facing euro dollar system. And historically, how many people ever even heard of the euro dollar system? Most, especially on social media, haven't heard of it other than through Jeff Snyder's work. And this is all recent. This is the last couple of years. Maybe his stuff was presented professionally, but it wasn't public, especially as disseminated as it is now on social media. No one knew what the frick a Eurodollar was. No one knew what OTC derivatives were and how big these systems were. $700 trillion OTC derivatives market, several quadrillion-dollar Eurodollar market that nobody knows the components of or the collateralization health. So in many regards, the crypto space has taught the general public a lot of the traditional financial world, collateralization health, leverage, debt positions. Um, these are powerful financial tools that we never had access to. But then we were exposed to them, and then we were like, oh, this is what they've been doing all of those years. So I think, and we'll continue to iterate that, or continue to say that stablecoins are one of the most profound offerings of the crypto space. Um, CDPs in particular. Now, what are the CDPs? You have DAI, you have MIM, you have Chi from QiDao. Well, not Chi. Chi is their governance token, but Mai is their the stablecoin. It's actually quite under discussed, the breadth and scope. Mai is probably has the widest reach of any stablecoin across non-mainnet Ethereum. It's everywhere. QiDao is if you want liquidity across any of the non-mainnet chains, QiDao has a capacity to probably facilitate it, especially its leverage. And it's a very interesting tokenomics because it's incentivized borrowing, and it's that which is not typical as compared to like what Maker does and what Abracadabra does for MIM. Um, so that's why it has been on my radar. Now, I've historically not had too much of a high opinion of Maker, but what several things can be said. It's not going anywhere. It's going to be around, and I can't speak. I don't want to speak too much about the MKR token. It's not performed well. It doesn't fit into our thesis for how to construct a portfolio. These are obvious things, and but from a technology standpoint, it's quite profound. It's the whole point of the stream. What are the profound offerings of the crypto space? Um, it just it's not productive, and therefore it doesn't fit into our value thesis of an asset that we could purchase at a discounted price, such that it's productive in our portfolio, and we bought it for cheap. We want to buy shit that's productive as cheap as possible, and that's the simple rule for how to manage the portfolio. But the hardest thing isn't really, well, obviously everything has its own level of difficulty, so we have to manage the portfolio. We want it to make it productive, but we also need rules to identify assets that are potentially meaningful to include in the portfolio. So that's these profound offerings of the crypto space. But Maker and countless other protocols are great examples of entrenched technology that has critical mass. It's not going anywhere. It's going to be there. But you can have great technology and it's not a good investment. We've seen that time and time again. Bancor. What? Did I say that out loud? I said the quiet parts out loud. It's great technology. There's incredible innovation that they tried to do something that was potentially meaningful, something novel, something sophisticated. And it may very well continue to be something innovative and emerge into something even more profound. But it isn't right now, and it hasn't been a good investment. But if anyone's trying something new, it's them. I think that was a clever thing they tried to transfer the impermanent laws to the protocol and tokenomics, and you know, I would never. I don't like when folks discredit attempts on social media. There was a lot of criticism of what they tried to do, but they tried to do it, and that's what's meaningful. And trying to do something is the only way you get profound creations. You have to try and experiment. Um, The other profound thing we could talk about, and I see you guys got a bunch of comments as always, and I would like to touch on them, is the federations. Now, the federations are as much as I talk about stablecoins as being one of the most profound manifestations of the crypto space, I think the federations are like of equivalent significance. But it's not a creation. It's a social phenomena, and it's not tokenomics. Tokenomics caused the federation to emerge, but the federation is a contract between protocols. It's maybe an unspoken contract or an incentivized contract where there's an agreement, there's coordination, there's strategy. And that is probably going to drive a good part of the most success in the crypto space is these federations. Why? Because that's historically what always occurs between sovereign nations. Now, we look to the federations of the planet to understand what's going to happen with these protocol federations. Why is the dollar what it is? Because every goddamn country on the planet decided to price all their shit in dollars. So if they're pricing everything in dollars, if you want to save for a rainy day, you have to collect dollars and have them such that you can purchase things. Now, there's an order of magnitude separation between these crypto federations because these assets are not involved in buying and selling goods of consumer staples and natural resources, so on and so forth, and goods and services. But look at Curve. Why would you collect Curve? It would be like collecting dollars gives you voting rights over Federal Reserve monetary policy. So that's why you collect it. You try and accumulate it. You hoard it. You put it into reserves, and that's what these protocols are doing. Because having control over monetary policy affects the lifeblood of these other protocols. It's in their best interest to have as much Curve as possible so that they could use the monetary policy of Curve to strengthen their protocol, to pay for the deep liquidity, to print so they don't have to. So DeFi 1.0 was plagued with all this inflation because protocols were using their own printing to pay for liquidity. And that's failed monetary policy. That's hyperinflation 101. That's like an emerging market. Like pick a random African country with a horrible currency at the moment, and they're just printing, and they're using that printed money to buy goods and services from other countries. It's going to be the death of the currency, inevitably, as time and history show over and over again. But if they're look at was it Switzerland, the franc, where they printed the franc and they bought U.S. Assets. So now, I guess that different strategy has overtones to what it means to put something valuable in reserves. If you're just printing to pay and to spend, it's a death of a currency. That was DeFi 1.0. That was the pool twos that everyone may have heard of. But if you're printing, and a lot of protocols do that, there is an emission schedules and inflations that go on across crypto protocols, but they're also accumulating valuable reserves, and this plays into really what Olympus kind of started, and what Wonderland did, and what Redacted just pivoted big time. The notion of a reserve of assets that are productive, that pay, and give them control and influence and power over other protocols. And it's not like malicious control, influence, and power. They're accumulating Curve so that they could vote on LP positions to incentivize deep liquidity. Why is that powerful? Because people will pay for that. If I get VC funding and I want to start a protocol, I want to create something out of nothing, I have an idea for a business, an enterprise, and I need a token, I need liquidity with, let's say, USDC so that you can actually trade it. It'll cost me, let's say, $1 million to incentivize proper deep liquidity. But instead, if I rent Curve, I could probably rent it for like $125,000. Like the point is, I could rent Curve for less money than it will cost me to pay for the deep liquidity. It's more capital efficient. So this is becoming it's tokenized, commoditized inflation. I think I've said that phrase before. It's becoming a commodity, and protocols have seen that, and they're accumulating it, and they're hoarding it. So this is the Federation, and that was what Curve showed us. And Curve was a horrible, rocky start. I don't have anything on the screen that's interesting, but I think the story is interesting because Curve was a horrible start. This was a hyperinflationary decay. There was nothing. It was. I don't even think they knew what was going to come of the protocol. Now Balancer as well has a pretty shit chart because the VE tokenomics came out way before you had any Federation components. But Aura is really a manifestation of what Curve showed us is possible. So this is very much leapfrogging a lot of the pain um, that us original DeFi participants experienced during the early days, late 2019, early 2020. I mean, the sales are overwhelmingly bought. It's printing higher highs, yet it's inflation. This is extraordinary from a convex comparison. And BAO, this entire region right here from the low. This is all Aura. Aura launched basically at the bottom. It launched in like June. That the sequence of events for the Aura Balancer Federation is quite interesting, given when Aura launched and what it does as compared to the convex curve relationship. This is the second federation protocol, and an unsung hero or an unsung participant or not the most well-known participant in both federations. You know who dominates convex? Well, not unilaterally, but you know who's also dominating Aura? Badger. Most people don't talk about it or maybe don't know about it, but Badger has a lot of control over curve emissions and balancer incentives. They have large treasuries. They have large reserves. They are a powerful component of the federations. Very interesting. And it's the story because if you look at what I said on Twitter and even in the description of this YouTube stream, people look at cash tags and they look at charts, but each of these charts tell a story, and we have historical context to understand the behavior of these protocols and what they mean metaphorically, but also actually. Because while it's metaphorical to these historical, or it's metaphorical to like sovereign nations, like a country, this is software, it's a protocol, it's actually doing it. So it's metaphorical. It's not a country, but it's actually holding shit in reserves. There's inflation that's used to pay for things. There's intentional deflationary pressure. So all this stuff has MMT written all over it also. But it's so much more robust than anything we've ever seen tried in the real world federations between countries. We've never seen software coordinate like this, which is exactly why I talk about this shit in terms of emerging markets. The behavior of these protocols, which um, is obviously coded by developers that have a strategy in mind, but the behavior of the price points and the market actors engaging with these protocols behave like emerging market capital flows, like emerging market currencies. I mean, ultimately, as these are currencies, are more liquid with currencies that could be used to buy real world goods and services, especially consumer staples, food, so on and so forth. I think that opaqueness of the relationship between these currencies and sovereign nations will break down and it'll become more obvious like, oh, these are emerging markets because they behave like emerging markets. The capital flow between the protocols, the fighting to accumulate reserves, to gain power and leverage and influence monetary policy. Woo! That's crazy. Isn't that exciting? That's an profound observation. The few profound phenomena of the crypto space is the damn federations. And this is relatively new. 3 months, 2 months, and two and change. But they did it right. They did it. They iterated on what Curve and Convex showed us could be possible. And what's the interesting thing? We also saw solidly epically fail because the social not only did the monetary policy fail, but the social contract failed. That thing just was a complete failed attempt. But this is working. Why? Because aura is accumulating, and because aura is accumulating, it's going to have a psychological impact on the other protocols, the other markets, the other actors in this emerging market space. These are EMs. It's going to influence them to want a piece of what aura is accumulating in reserves. Why? Because they're accumulating it in reserves, and if another protocol doesn't step in, aura is going to have dominance, so there's competition. They're going to see it as if I don't do it now, I'm not going to be able to do it. So other protocols are stepping in to accumulate, and that's exactly what Redacted saw, why they took a piece, and others will. And then they'll fight over aura, which is exactly what happened with Convex. Then you had the protocols fighting over owning Convex, which Frax dominated. And I haven't checked the statistics lately, but I'm pretty sure they still dominate Convex. And then you get derivatives. Staked Out was not off to a good start with the way they structured their derivatives, but they did very well with this current set of derivatives. Curve, Frax, Angle, Bow. They did very good. They finally pivoted, and this presentation is very nice. Now, I'm going from a narrative type of conversation to an opinion about a protocol. Now, bear in mind, I have a good opinion of Staked Out, but it's not from me. It's not from me because it's a derivative. I don't want the derivative. I want the base layer. It's just a rule, my rule. You don't have to follow it. You could like SD Curve. You could like any derivative you want. Was it MCRV, which is what Abracadabra will end up having, or whatever derivative. What does the llama do? Pyrex with the union. The pounders. Pyrex convex. You can pick a derivative if you want, but it's not for me. It's not what I want. I want the base layer. Why? Why do I want the base layer? I think it's going to be scarce. I think VECRV is going to be scarce from a retail perspective because I think there's going to be so many protocols that have so much more power and influence as compared to individual market actors that they're just going to accumulate, and they're going to end up being able to have more capacity to accumulate more than retail actors, such that if you're a retail actor, there's going to be few. So that's how I define my rules to engage with the market. So I like the base layer. Now I haven't engaged with the base layer of VE BAL significantly. I had a small position before Aura launched, probably because it's just not productive yet. The reason VE Curve is productive is because of the bribes. But the bribes for VE BAL are just not there yet. Let's go over to Hidden Hand. Oh, Bia, look at this infrastructure. It's actually quite extraordinary. The Hidden Hand. This didn't exist when VE Curve launched. Nothing existed. Curve just got slaughtered. There was nothing. Hyperinflationary crush. Nothing existed, but all this infrastructure for the Balancer Aura Federation. This is off to one heck of a start, and I wish I saw this sooner. I'm not disappointed with where I'm at, but damn, this might be one of the biggest things thus far, at least in 2022. Watching at the bottom of the bear. Wow. So I wish there was more of a. I could do some calculations to see what kind of emissions per vote. Okay, this is new. They finally got that calculation out. So 15 cents is not much. VE BAL is expensive. VE BAL is like what 18, 20 bucks, something like that. So it's quite pricey. So it's not the most productive. Whereas VL Aura BAL is very productive, 86%. And if you want Ethereum exposure, you get over 100%. Or if you want CVX CRV paired with CVX exposure, that's at 90%. If you guys must know, this is literally curved CVX CRV, CRV, LP. Just the Aura Balancer Federation version of it. All right, enough rambling from me. Let me answer some questions, and we'll get this day cooking. Dan's in the house. Good morning, Crypto Jake. Dan said manifold. Manifold is very meaningful. The proof of stake merge is coming up, and how to handle MEV is probably more important than ever. So it's just not something I'm exposed to. Earman's in the house. Dr. Clayton, Asun, good morning. Shisha, are you going to dump your CVX for FXS? No. I'm quite likely going to exit my CVX position because I don't need overexposure to the convex curve federation. The predominant position I have is curve, so why do I have a convex position? I don't need it. So my locks don't come up for a bit though. Let's take a look. October 19th. So I got what? Almost 2 months, 8 weeks. So this is a relatively small amount. I just wanted an even 30,000. So October 19th, I'm probably going to exit my convex position. I'll be at 29%. Is nothing to sneeze at. I just don't need it. I want it for something else, and that's just my uh, uh, subjective opinion of what action I would take. Raul's in the house. Humberto, Beans. Yeah, there's a laundry list of shit. I'm sure Beans has been talked about in our Discord forum at some point, and maybe it's worthwhile for it to come back on the radar. Dan, did you see Crypto Condom's proposal to deepen Frax liquidity on GMX? Nice to see more Frax expansion. See, GMX is cool stuff, but look, base layer Frax. Frax is going to do very well in the coming years, and I'm very content with that base VEFXS position. I don't even have the chart up. Let's take a look at FXS. Yeah, it's boring. but there's something special about it, and that's very rare for me, especially nowadays with the way I construct the portfolio for it to be maximally productive. Very value investor centric mentality. So it's not the most productive, but there's something special about it. And what happens when the market figures out there's something special about something, it quickly becomes not cheap. So fortunately, I can't do anything about it because it's a lock V FXS position, and it is what it is. I'm along for the ride, but I'm content with that because my opinion of what Sam does, it's profound. It's something that the other stablecoins don't do. The richness of the protocol goes beyond just the stablecoin. Anything, the offerings that Frax has is very central bankish. It's big, it's grand, and Fraxland I think should just add to that repertoire of offerings of the protocol that will only deepen its entrenchment in the crypto space. Johannes, good day. Always a pleasure. Always a pleasure. Brian, good morning. Zoidberg, Christoph, does Stargate currently offer a share of revenue? If not, what's to appeal to VESTG? Nothing currently from a productivity standpoint. I'm inclined to think it should be meaningfully productive at some point. Now, as compared to the other bridges, I speculatively have a high opinion of Stargate. I have a decent sized position that I got from the original bond, and I doubled the position size literally at the bottom, and then all of a sudden this ship was ripping to $1, so that was pretty cool. So I go to a good price point. I have mine locked for like 5,000 years. I can't touch it if I wanted to, and it's not productive. So productive assets, yeah, there's a speculative component to them, but they're productive. So if it's paying you on the weekly, it doesn't matter if it goes up in price significantly. What you want is the weekly revenue. Now, you can't just have a portfolio of just productive value assets. You need growth also. So I always advocate for a small part of the portfolio, the smaller part. And this is why I always say 1% to 10% changes everything. And that's like a Stargate. And I would say Frax is part of that, albeit it has had the overtones of potentially being productive imminently. But Frax is part of the growth side of the portfolio. Um, so that's good. That's good. I have a good opinion of Stargate Layer Zero, and especially of the team that's building it. Now, bear in mind, Stargate has finally figured out that it's more capital efficient to bribe at the base VE curve layer, so that's pretty cool. It looks like we potentially have a new participant in base VE curve bribe. So we have the historic bribers through these original portals. Curve has been the highest payer of their own incentivized votes for quite a long time. Andre pointed that one out. This usually takes a second to load. But Vodium, um, I mean, 0.95 cents. And Stargate, I mean, so this is going to be volatile, but that'd be a nice weekly return. But a penny per VECRV, you're talking 1% at $1. A penny per VECRV is 1% at $1. 1% per week, 52% per year. Come on. With the potential growth and expansion of these emerging markets, that's an extraordinary opportunity. So look, I'm looking at Vodium to understand the Curve protocol, and then someone goes to look at Curve, and this shit'll be like, what the heck is this? But this is profound technology. It really is. Let's go back. I wanna take a look at the revenue. So 8%. So again, 8% down there, you get in 40, 50% on the incentivized voting, which you can see here, presented very nicely on Stake DAO, 40 something percent. Heck of a productive asset. It turns out, literally, base VECRV that folks writ off in large part during 2020 2020 and during its initial launch is an extraordinarily productive asset. It's not going to go the same way for whatever the hell Uni's cooking up for their fee share. It just doesn't have the momentum. Hey fam, caught a live stream. Peter's in the house. A pleasure. Yeah, Badger hype back in 2020, but Badger's never gone away. They're stronger than ever, and they have a large treasury. So they have a lot of power. What that means from a financial perspective, I don't know. We could get speculative. Well, I want to see a dollar denominator. Let's go over to, let's change this chart. By the way, the 10 years absolutely crushing it today in yields. This is wild, but this is also a massive head and shoulders. And with this, I'm not going to get into macro, but holy crap, there's a lot going on in macro. Badger. So Badger's just crushed because it's an inflationary protocol, and that was the hope of Citadel when it launches, is to bring a little bit more of reflexivity to it, to encourage other participants and really use Badger for what it's meant to do. It's meant to be the inflationary currency part of the equation, where Badger's used to drive activity, incentivize activity. But it needs other actors to consume it. It needs more of a federation. So a Badger federation might not be out of the question in the future. It would make sense. Frankly, everyone should be wanting to build a federation. It's by far one of the most profound manifestations of the entire crypto space. Dan, what portfolio allocation would you dedicate to Aura Bal at this point? For myself, yeah, I mean, there's reason to think that it should be a higher than a speculative bet, because it's literally productive out of the gate, and it hits the Federation overtones. You could have it a meaningful percentage, but expect volatility. What have I said? I've said a couple of good catchphrases of late. Expect it to go down. Whatever you buy, expect it to go down. How does that make you feel? If you buy something, you spend 10 grand on something, and it goes down to 4 grand, 3 grand, how does that make you feel? If you're okay with that and you want to take the position, it's a win-win. One, you expected it to go down, so you were right. And two, if it goes up, great. You expected it to go down, it went up. So if you enter any position expecting it to go down, you will always win, because you will always be right. And you will always be prepared. You expected it to go down, so you sized it accordingly. So if it went down 50%, 80% on the money, you didn't lose and destroy your entire portfolio. And if it goes up, bam, there you go. That's how you turn 2% into 20% of the portfolio. And then you probably should rebalance and restructure accordingly. Without having the six-figure capital to lock up as VCRV, do you have an opinion on CVX CRV or Pounder CRV? Well, obviously I must be subjective, because I'm me, and my opinion remains that they're derivatives. So what's my opinion of derivatives? Derivatives ultimately benefit the base layer. Derivatives will remain productive. Derivatives become competitive, meaning there's always going to be another derivative because of competition. So you may end up swapping derivatives. You go from one to the other, trying to outperform. It's, not a rat race, because they'll all be productive, but you'll end up having to manage more. So the base layer is supported by the derivatives, because the derivatives are in it for themselves. They're in it to win it. Did I really just say that? So for their own livelihood, the derivatives are doing what they're doing, and ultimately they're all going to support just the base layer. That's my rule that I follow. So there's nothing wrong with the derivatives, Dan. They're great. SDCRV is hella productive. I just don't want to buy it, one, have the option to sell it for what? A pounder or another productive asset or another curve derivative. I don't want to have to manage. I'm at the point where the portfolio I'm grateful that I have these positions. I'm like, all right, good. I don't have to do anything. I'm going to check back in a couple of years. I'm going to let 10 new protocols come online. I'm going to let them fight over curve governance. They're going to do what they're going to do. I don't have to think about them because in the end, there's going to be a scarcity of base v ECRV held by retail, in my opinion. So all of their activity, all of that competition, all of that fighting over resources and trying to carve out a bit of a curve reserve will just benefit uh, my original position. So that's generally my opinion. So I don't have a bad opinion of the derivatives. I just think that they'll require more work to have a portfolio that operates at peak performance. FM thoughts on ICOSA? Yeah, so I like that. That's very interesting. Um, so there's a couple of hex derivatives finally, which is basically in the tone of what Abracadabra did with the Genbox and Convex. So that's cool. What they're finally starting to do is create derivatives. Um, and that is imperative for the survival of the protocol. Unto itself, a protocol, any protocol, not just hex, uh, it doesn't do much. There's no roots. You got to think of it as a root system. So the strength of a financial uh, primitive is how much roots it grows, which is entrenchment, which is how many derivatives are consuming it. So I would say it's a start. Um, the first rule of thumb. There's many rules of thumbs with these types of investments. One, don't dismiss anything. So I don't dismiss Hex. I just don't think it has roots. I don't think it has a federation. I think it doesn't have the critical components that I think are most meaningful to a portfolio. So, but this is a start. If you could encapsulate a staked position into something that's fungible and portable and collateralizable, they're finally starting to have components and Legos, and that's a good thing. So it's still not something that's very interesting to me. These types of things have been tried with countless other protocols, and there's collateralization all over the place. And you'll see. I know you like that ecosystem, so good. Keep an eye on it. Keep me posted. I've said I'm interested. And the other rule of thumb is the most important rule of thumb. There's no holy grail. There's no holy shit. This changes everything. There's no magic. What there is the events of today, and you have to see how they unfold. So what you see is a new protocol. It has implications for the base layer, and you got to see other participants. You got to see how things play out. There's no such thing as like, wow, this new protocol came online, it changes everything. So for instance, Aura and Balancer. Aura did something profound. But if Aura was just Aura, it wouldn't be as significant as holy crap, Balancer's accumulating. Holy crap, Redacted's accumulating. And that's going to cause reflexivity, as Soros talks about, for other participants to start engaging with the Federation. That's the real profound thing, is when one action causes other people to act, causes other people to act, causes other people to act. If you see that, when you see that, that's when you take off a bigger bite. Loki, you want to talk macro for a couple of seconds? DXY. All right, let's look at the dollar real quick. Let me see if there's any other questions, and I can talk about the dollar real quick. Raul, when I listen to your streams, it makes me want to ape, but I know I have to be patient. There'll probably come a moment in the coming months. Well, don't ape. What you want is to accumulate positions. With smaller portfolios, dollar cost averaging is meaningful, and compounding is meaningful. Um, and you want to be more concentrated probably with the smaller portfolios. You want to be less diversified because you need positions that are meaningful. Excess diversification destroys a portfolio, and you still want to be productive because you want to look for these assets with these attributes that exhibit value. I'm such a value investor. Um, and those are the things that you want to accumulate. So you don't ape. I know we want to, but take positions. You should pretty much always be buying things to build an initial portfolio. The whole question is how much, and the most important thing is expectations, which I have said earlier in the stream. Expect it to go down because then it's a win-win expectation. If you expect it to go down, you win. And if it goes up, great. It didn't go down. So it's a win-win. um, I haven't seen Arthur's latest piece, so I can't speak to it specifically. But pretty much anything he says is gold. Smart guy. Raul, what's the best way to stake Orabao? Buy Orabao from Balancer and stake it to buy Bao. You're going to have to play around with that shit. There's obviously, you could buy Orabao, but there's slippage. You could buy Bao and mint it, or you could buy, 80% Bao, 20% Ethereum. So there's a variety of ways to get into an Orabao position. Obviously, all things considered, respect the portfolio. Are there similar productive protocols on NEL2 or EVMs with lower fees that also have staying power? Well, staying power, use the word survivability. You need that component. So, well, there's no federation on the L2s. I mean, Beethoven is something always to keep an eye on because they had a bit of a federation, but it was very isolated to Phantom, and Phantom was small, and then it got big, and then it imploded as solidly, completely cleared, flash burned the entire chain. um, but they have potential. Um, there's probably a lot of things on the L2s that I don't know that's going on at the smaller scale. So as you guys hear these narratives, these stories, give me feedback in the forum as well as on stream about things that will be of interest to the community that have these overtones of the things that I'm interested in. Federation is probably the biggest one. Are there similar productive protocols? I nailed that. Loki. Okay, let's do dollar real quick and we'll wrap it up. Holy crap, the dollar. So bear in mind, this pretty much looks like a diamond top of sorts. Bear in mind, it's only the 4 hour. If you go out to the daily, you don't have that. Um, so we didn't have a full bearish engulfing, but I don't think this is an inverted hammer. I don't think this qualifies as a bottom. Um, Anything could happen because what's important to understand about macro is yes, the chart is expressing current behavior, but you could literally have a sovereign that has like an absolute debt crisis and they literally need to sell every single U.S. bond they have in reserves and buy every dollar they could possibly find, and all of a sudden the dollar just rips to 110 in the blink of an eye. So it's unpredictable in that regard, but from a technical perspective, this is a full-on topping pattern. Double top running out of steam. It couldn't breach the new higher high. You got a lower high. You're below the TWAP of the 4 hour. Even on the RSI, this is what's quite interesting on the RSI. We had a RSI tops back in June, and it couldn't get to a new higher high. Couldn't get to a new higher high. So we have a bearish divergence. From a technical perspective, you go out to the daily, you have that as well. And even the most recent is lower. So it's significantly lower. So for technical strength, topped out in April. It's quite a meaningful divergence. So where are we with TWAP? On the daily will drive you nuts. Let's go out to the TWAP on the weekly. Okay, 2 days for the weekly close. This would be very interesting if we have a larger wick to the upside. Like if this closes with a what a doji, that'd be wild. It'd be a big shooting star, which is what we had here, and it drove it down to resist it, to support a big close here, and we could start to see over the next week or two a drive down towards TWAP support, probably 105, 106, maybe 10 SMA. 107 would be the first stop. Let's go out to the monthly real quick. So this is really the chart that I look at most with most assets. I don't have time for the shorter time frames. It'll drive you nuts. So 7 days. We have 7 days to see what happens. 1 week. This could be one of the most significant candles going right now in a lot of charts from a technical perspective. If we have a large rip down and we close this month at 105, this would be one of the craziest tweezer tops in a long time. Now, what happens with tweezer tops? Tweezer top, 2016. Just a wild wick top. This was beyond the tweezer top in 2020. And then we have to go back to 85. Tweezies. So, trend reversal. To top it all off, it's a rising wedge formation. So from a technical perspective, there's all the indication in the world that we are running out of steam from a dollar perspective, dollar bullishness. But just remember, when I started this dollar talk, I said you can have a variety of macroeconomic conditions that say, fuck technicals, this thing's going to 120. And it's going to probably cause some sort of crisis in the financial landscape. FX reserves, sovereign collateral situations, what they got in their books with regard to bonds and treasury, so on and so forth. So my eyes are probably on optimally in the next 7 days a run towards a $1.05, 105. That would be a wild technical presentation if this closes with a double massive wick to the upside. It'll be the largest tweezer top on the dollar monthly in decades. And for your reference, this is why it's so complicated to allocate capital in the crypto space. Look at these purple boxes. You know, what's beautiful about charts is that you could encapsulate everything that's occurred in these crypto markets into two little purple boxes. What is this dollar depreciation? This is inversely correlated to basically everything appreciating. As the dollar goes down in price, assets go up in price. So this is Bitcoin from a couple $100 to 20 grand. This is Bitcoin from $3,000 to $68,000. What happens if we have an increasingly pronounced tweezer top, two massive wicks to the upside, and a trend reversal of the DXY down to the TWAP at about 99, 100 by the time it gets there? Let's say it's about 100. One, that would be an incredible rally in risk assets. And two, that would be a horrible thing to see from a technical perspective. Support put in at that level. That'd be really scary. This has previous resistance, flip support. Look, failed breakout, and this is green line right here, failed breakout. And if this finally holds as support right around here, woo, that is going to be ugly from a risk asset perspective. The dollar puts in a resistance, flip support at that level. Now, bear in mind, what the hell is the ascending wedge, the rising wedge significance? What's the significance there? So we don't know all the answers. We don't know what's going to happen, but these are some of the short-term macro observations that could play out from a technical perspective. And there's plenty of swans flying around, either black swans or white swans. So there's a whole lot of swans that could pop up and be like, "Hi, I'm a swan. Here you go. White swan. War's over. Risk assets go 10x on the money. Dollar crashes to 84. Everyone's happy. Okay. Last couple questions. Loki, you're welcome. Peter. When? You said when. Thoughts on author's latest? I don't know. Anyway, hi Noah. Can I ask how much is liquid? I'm not very liquid, albeit I have a large locked. I have savings. So I have a large locked Frax USDC position for like 2 years. So I did that on purpose. I questioned whether it was the best choice or not, but I did it, and clearly I thought about it a lot before I did it. So I have savings. I'll have cash in the next couple of years. All that considered, that's probably about 15%. Say about 15% of the portfolio is not liquid, but it's cash. Fiat is another story because crypto cannot be everything, so you need fiat. That's another. So I probably have a lot. It's a lot of cash. 30%, 40% is cash. So I do keep a fair amount of fiat just in case there's a complete deflationary implosion, and that's a hedge. As Raul always says, when you have a deflationary implosion, is buy bonds and diamonds. But cash, and he with cash during a recession is king. So if everything crashes in price, you need cash to be able to buy stuff. So food for thought. I don't have the answers. I just got stories. Loki, you're welcome. Thanks for the content, Noah. Heath, what are your stable allocations roughly at the moment? I hope that helps. That maybe gave some insight. Um, fair amount. Fair amount. Dan, L2 growing federations are with Dopex and it's with GMX. Yes. So bear in mind that's on our radar, and I've talked about GMX as a federation of sorts. It's not as it's not as organized and as robust as what literally what Aura did right out of the gate. Wild what they did. I wish I saw it, and I did. The 66-cent position, but I'm not the ape. I don't ape, so I took off a small bit. I wish I did 10x the size. Damn it. So you're absolutely right. And Arbitrim's a big deal with GMX, and they have a little bit of reach on Avalanche, so that's pretty cool. I wouldn't write off synthetics as a possible federation on optimism. So, you guys know I have the synthetics position. We talk about it in the forums. So, they have the overtones of it. It's like you sniff it out. Is it going to mature into something that's more robust? Is someone going to start really accumulating? And because that's what's obviously occurring with Aura. You don't get a price chart like this unless there's folks accumulating. Jeez, 390. Andre, my man. I'm going to finish this up. I got stuff to do. I got some diagrams to write, man. But that's pretty much where we are in the markets from a macro perspective. That's pretty much where we are from a crypto space perspective. And I hope that helps you guys. There's a lot of uncertainty out there. There's a lot of fear. There's a lot of just unending desire to get ahead. So just remember the rules. Follow the rules. And if you follow the rules, what the charts do is irrelevant. You want to buy productive assets cheap. You want to buy something that pays you cheap. That's Buffett. And and Soros tells you reflexivity. And these are the most successful capital allocators in history. He just doesn't know. Buffett just doesn't know. He just doesn't see it because it's the same reason I don't look at new assets. You see that, guys, right? Like I told you guys that, and Dan told me about what's going on in L2. I don't know what's going on in L2 because I don't need to know, and it's outside of just my capacity, the load, the bandwidth that I have to spend time, and you can imagine with half a $1 trillion of capital, Buffett doesn't have time for this million dollar protocol bullshit. It's just off his radar. But it's the same thing. We're literally doing, at least the story I tell you is a Buffett Soros story from a value investing standpoint. Thank you, everyone. It's a pleasure. Wednesday, August 24th at 12:36 p.m. I wish you all a wonderful day. Tell everyone to subscribe because we can only help people if they listen. As always, after party on Discord for the most rational community in the entire crypto space. I should get a stream out Friday, if not Monday. If that's the case, I wish you all a wonderful rest of the week and possibly weekend. I will see you then. Peace.